So you want to buy that new vehicle, but you don't know whether you want to walk into the dealership and finance it, or do you take all the money out of your IRA and just pay it off and be done with it? What is the best option? Is it to finance a new vehicle purchase in retirement, or is it to withdraw money from your IRA and just pay it off that way? There is no right or wrong answer. It all depends on the economic circumstances at the time you have to make that decision and what your current financial situation dictates is best. But there are a few rules of thumb you could rely on to use to help you make the best decision if you find yourself having to make that type of decision in the future. The first thing is to look at the pros and cons of each of the different options. So, do you want to pull it out of your IRA? The benefit of that is you don't have to finance it. You don't have a loan. You don't have to make a loan payment. You own it all. It's done with. You don't have to worry about anything after that. The con is taking money out of your IRA means less money invested, which, if investment markets do well, you will not make as much because you pulled that money out to buy a vehicle. What about financing? What if you roll into the dealership and finance that new vehicle purchase in retirement instead of pulling all of that money out of your IRA? Well, the benefit is that money stays in your IRA so it can continue to grow. The downside is now you have a car loan, and the interest attached to that loan is going to cost you more than if you would have just pulled the money out of your IRA to begin with, not including taxes, and paid it off from the beginning. The other downside, which doesn't get talked about enough, is it reduces your spending flexibility in retirement having additional debt. Retirees have a superpower, their ability to reduce their spending, tighten their belt in retirement temporarily if economic conditions deteriorate until investment markets start to do better. Well, if you have additional debt, it's hard to tighten your belt because regardless of what happens economically, you don't have the ability to tighten your belt as much when you're continuously required to meet that loan requirement every single month until your new vehicle is paid off. So those are the pros and cons. If I had to sway in either one direction or another, my recommendation, unless your financial situation dictates otherwise, is to pull the money out of the IRA to pay off the vehicle in full. Investment markets have performed well. So pulling money out of an IRA is realizing profits in 2025. And again, if you're watching this video at some other point in time in the future, maybe investment markets haven't produced the type of gains we've experienced so far in 2025. So your financial situation or investment performance could dictate otherwise. Realizing that profit and pulling from that account is ideal because now you're spending that money after it's profited so far this year. And I know you're going to have to pay tax on it if you're pulling it out of an IRA, but it's better than keeping that money in the investment account and having to withdraw on it at a future point in time when potentially those investment accounts could be lower than they are today because of a pullback in investment markets. Not having to pay interest on a loan over a 3 to 4 to 5 to 6 year period is also beneficial because it saves you money in the long run. The other side of it is, well, Derek, what if I pull money out of that IRA and investment markets continue to go up? Well, that's the worst case scenario. You continue to make money, but on less money, and your financial situation or retirement plan dictates you have the ability to not have to chase those gains. Then you get the best of both worlds, right? You don't have to go after that because your retirement plan says you don't absolutely need it. And you are realizing that profit. So if the other side of the coin happens and investment markets pull back, at least that money is not dropping in value when you're going to have to pull from that eventually at some point in the following year to make that vehicle payment. The other nice thing about paying it all off is you don't carry that debt, which means you retain flexibility in your cash flow. So if we do hit an economic circumstance that forces you to tighten your belt, you can do so much easier because you have more income flexibility not carrying that debt load. This is a decision that a lot of retirees make. Do I finance that new vehicle? Do I just take a withdrawal out of my IRA and pay it all off? Before you make that decision, you have to evaluate the economic circumstance you're in and your own financial situation to determine what's best. Outside of that, if you're just going by a rule of thumb or what Derek Delaney says you should do hypothetically in most circumstances, my feeling is that you should take it out of your IRA, pay it all off, and not have a debt payment, especially if you're in retirement. I personally see more benefit to that in most circumstances than the alternative. But before making that decision, consult your financial advisor, understand the pros and cons of how that decision will impact your long-term retirement plan, so you can confidently make that decision knowing that it's personally what's best for you and not making it just based off of a rule of thumb. My name is Derek Delaney. I'm a certified financial planner. If you feel like retaining a financial planner for a flat fee throughout retirement to help you with these type of decisions and everything else, I invite you to schedule a free consultation so you can learn more about the work I do for my clients to see if it could be impactful for you. Until that future conversation, happy retirement planning.